Hi, and good evening, everybody. Hello, Jatinder. Hello, Sam. Welcome to tonight's show. It's on SGX. So today we're gonna take a look at Singapore markets and how we can apply some technical analysis tools to identify trends. All right, because here we are today. The subject matter is about catching the SGX bulls by its horns. Right. So we do not want to catch the balls, we want to catch the bull's horns, right? So make sure you catch the right thing. Okay. If you can hear me, can you just say yes in the comment section so that I can begin? Good evening, Chin. Okay, welcome everybody. Welcome for tonight's session on Singapore stocks. Okay. So tonight is going to be a little bit educational. I'm going to introduce you an indicator which probably you already know, but if you probably heard of it, but I think if you know how to apply it, it's one of the best trend indicators you can find in technical analysis. All right. Oh, so awesome. Thank you. So guys, thank you. Okay, looks like we're all set to go. Let me just share my screen. Yeah? So if you have your pen and paper, you may want to jot this down because today, like I said, it's going to be educational, and then we're going to see how we can apply to analyze the Singapore stocks. All right, so I've prepared actually a list of you to also look at, right, once we go through today's webinar. Jason, catch the what? Yeah, make sure you don't catch the balls. Okay, you want to catch the horns. All right, let me just share my screen, yeah. Okay. Once again, thank you so much for joining us tonight. We are on Singapore Tuesday, so we basically the subject matter is on Singapore stocks, and today is all about technicals, right, or price chart analysis. So tonight's title, we're gonna we name it as Catch the SGX Bulls by its horns. We know that the market is currently in a bullish trend, right? It is easy to identify a trend, but how do we really catch the bull? All right. If you do not know how to catch the bull, then you probably get a stampede from the bullish trend itself. So you don't want to be caught getting trampled. All right. And if you know how to do it, of course, there are opportunities here in the SGX market, and later I'll show you some of the charts, and I'll give you an opportunity as well to look for you to ask any stocks that you want to look at it when you want to look at, all right, by applying what we're going to learn today. Yeah, KP Chin, catching the balls will make the bull run faster. Yeah, so if you catch the balls, the bull run faster, then you cannot chase them, right? They'll just run forward, and you basically miss the trend. But if you are able to catch the horns, then you're able to control it. All right. So the idea is to basically control that trend, right, by applying your own trading plan now. Okay, so let me just go to my slides. Right. So before this, whatever that's being shared here tonight, I have to give a disclaimer first. Okay, it's basically for educational purposes only. It's not intended as any investment advice, and whatever that stocks that we're going to look at today is basically what we're going to learn based on some tools that we're going to apply. All right. If you want to look for investment advice, please do look for a licensed and professional investment advisor. Okay. So we all know about price trends, right? That's the easiest part to identify, because if the price has been going up, right, and then you know that the price is going up higher and higher and higher, that's trend. That's a bullish trend, right? And if the price continue to go down, that's a bearish trend. Okay, so in technical analysis, we need to look at a few aspects on price trends. Okay, we need to look at the characteristics of price trends. Then we understand the behavior of those trends. Okay, so if you have any questions at all as I present, you just have to ask the questions on the comment section. Then I'll try to answer your questions. All right. So now, so there are basically three trends, right? One of the, of course, most important part of trend characteristic is to identify the direction of the trend, right? So we know that if the price goes sideways, it's not moving into any direction. You can see the highs and the lows are almost equal over time. Okay, they just go sideways. There's no certain direction. Then it's a sideways trend. Okay, and like I said, it's always easy to look at a trend when the prices are already historical. And like what we see now here is a historical price chart. Okay, and the problem with historical price chart, of course, is that we cannot buy at the historical prices anymore, lah. Right? We need to actually look forward and see where the trend is going to go. Okay, so if we have the highs are going higher and the lows are going higher, then we have a bullish trend. Now, so we are looking at a bullish bias right now because in the stock market, you know, we can only buy, assuming that we can only buy and we can't go short, right? And of course, there's only one way to make money or make profits from the markets is when the prices go up, if the market does not allow us to go short, right? So if the price goes up in an uptrend, the question is, how do we ride this trend? Okay, what we do not want to do is to buy when the prices are high, right? We want to, like, for example, now if the price is at historical high, if it's a historical high, it simply means that the price is in a bullish trend, right? But we do not want to buy at a historical high, right? And another question is, yes, I know it's a bullish trend, but is this trend going to continue, right? So these are some things that we're going to take a look at today. So a bearish trend is when price goes lower and lower and lower, when the highs are getting lower and the lows are getting lower, right? So this, again, historically is easy to identify. Even if you ask a 6-year-old boy or a 5-year-old boy, eventually now, even if you ask a 3-year-old boy, they can tell you whether the prices are going up or going down, right? By simply looking at the direction of the price movement. Okay, so the first thing you have to identify is which trend are we currently trading, right? Are we in a bullish trend or are we in a bearish trend? Okay, now the next thing that we need to understand about trend is strength. Okay, the momentum. That means momentum means the rate of change, right? So you can look at the current movement. Is it stronger than the previous movement or is it weaker? Now, for example, if you look at this first chart on the left, right, you can see the first movement upward, it was a small one, and then the price pulled back for a correction. There's some profit taking here, and then it moves the second one, which is bigger than the first one, and then moves into a correction, and then it moves the third one, which is even stronger than the previous one. So you can see that the rate of change here, or the momentum of the trend, is strong. All right, as compared to the next chart, you can see that although the price is in a bullish trend, okay, but you look at the magnitude of the price movement upwards, is actually getting smaller and smaller and smaller. It's like the steps are getting smaller. Okay, in other words, the momentum of that uptrend is weak. Okay, or the rate of change in price is getting weaker. Okay, so we have strong uptrend, we have weak uptrend. Now, generally, if the trend is strong, then we expect the bullish trend to continue. All right. If the trend is weak, then we're probably going to expect the price to either turn the other way around, form a bearish reversal, or probably just go sideways. Okay. Now, why is that so, right? So if you understand the market, if the price goes up easily, if it goes up high and high and higher easily, it simply tells us that there is not much selling, right? There's not much resistance from preventing the price going higher. So it's a very strong trend. It's like there's no hurdle at all. All right. In a weak trend, you can see that whenever the price goes up a little bit higher, then you see selling comes in and they push the price down lower. It goes up a little bit higher, then the selling comes in and push it down some more. Okay, so when we look at a strong uptrend, when you have a strong trend momentum or strength, it simply means that there's not much resistance, or there's not much selling pressure. Okay, in a weak uptrend, then we have selling pressure as well. Okay, that prevents the price from going up much faster. So that's the characteristic or the behavior behind the price movements. So we also have a downtrend, and you can see here the downtrend, the magnitude of it falling is higher than the previous movements. Okay, so we have a very strong downtrend, or we have a very strong downtrend momentum. Okay, it's the opposite of a strong uptrend that we looked at earlier. Now, why we see a very strong downtrend is because when the price goes down very aggressively, even though there's some buying, but the buying was weak. right? The price just go up a little bit before it comes down somewhat aggressively. So here simply shows that there is very little support, right? There's little buying, and therefore price can go down easily. Okay, if the price goes down and it's weaker, that means it goes down in the momentum or the rate of change is lower. Then we see that although the price is going down, but there's quite a number of support here, right? There is buying interest that prevents the price from going down very fast. All right. So by understanding these characteristics, then we basically know what to expect of a trend. Okay. So in other words, like in this strong downtrend, when we have a strong downtrend, we're going to expect the downtrend to continue. When we have a weak downtrend, then the trend may still continue, but there's also a high chance that the price is probably going to reverse, okay, or just go sideways because there is buying support. All right. So I hope you are clear here. Are there any questions before I go on? All right. So if there are no questions, then I just continue. Yeah. Okay. Next one. Basically, we use technical indicators, right, to identify or to give us an indication of a price action. Okay, in this case, we are trying to identify trends, right? So we'll be applying trend indicators. If you're trying to identify reversal patterns, like the candlestick pattern that I've actually shared with you guys, I think about a month ago. Now, if you missed that, you can always go back and look at our videos which are recorded, right? Because that's where we're going to take a look at indicators like candlesticks that is used to identify whether the price is bottoming out or not. All right. But when we look at trend indicators, okay, the mother of all trend indicators is the moving average. Okay, this is an indicator that every analyst will probably use, all right. It's a very simple indicator, but it's a very important indicator. Okay, but of course there are pros and cons. There are strengths and weaknesses, and I'm going to explain to you the strengths and weaknesses in a short while. Okay. So we're going to take a look at the moving average. And of course, today's indicator is not about the moving average, right? We have better indicators than this. So let's take a look at the indicator first. Because we want to see how we actually apply an indicator and what is the indicator trying to indicate. So remember, indicators are just indications, right? There are signals. But when you make a decision to buy or sell, it is still up to you, right, on what kind of signals you use, what kind of indicators you use. Okay, a lot of traders make mistake. They use the indicators as a buy and sell signal themselves. All right, you need to understand first of all why those indicators are being used. Then you know why you actually make that trading decision. All right, so moving average is a very simple indicator. So the name the name itself says that it's an average. Right, it's an average price calculation. It is moving. It's called moving because every day a new data comes in, right? And then you have to recalculate it again. If let's say you're looking at a daily chart, but if you're looking at a 5-minute chart, every 5 minutes a data will form, and then you have to recalculate again every 5 minutes to get a new average prices. Now, let's say for example, right, you have the first 5 days, okay. So first day is 120, second day 126, 125. And I want to apply a 5-day moving average. So I have to have at least 5 days of data first before I can calculate the average. If I only have 1 day of data, then I cannot calculate the average, right? Because I'm calculating a 5 days average. So I need to have 5 days first. Okay, so third day is 125, fourth day is 122, fifth day is 124. So how do I calculate this 5 days average? So the price here moves at 120, 126, 125. You know, it just fluctuates, right? So you want to calculate the average, you just add all the 5 days up, right? The data for the first or the price for the first 5 days, you add them up and you divide by 5. And therefore, if you do that calculation, you get the average at 123. Okay. Now, then the next day comes in, right? The 6th day comes in. The 6th day, we get the price trading at close at 128. So now I have to recalculate again the last 5 days of data from the 6th day, from the last day. Okay, so 128 plus 124, 122, 125 plus 126. You divide by 5, you get 125. Okay, so new data comes in again and you recalculate again, and you can see that the average here goes from 123, it goes 125, 126, 127. Okay, as long as the price keeps on trading above the average prices, then your average will keep on increasing. Right? Because if the price is trading below the average, and when you recalculate it again, your average may start to turn or may start to go lower. All right, so what it tells you basically that if I'm just going to use the moving average as an indicator, okay, if the price is trading above the average, it tells me that the price is going up, right? If the price is trading below the average, it simply means that the price is going down. And that's the reason why they use it as a trend indicator. Okay. So of course, 5 days average is a short-term average, and then you can even put in, let's say, a 1-year average, right? Let's say a 360 day, or maybe 260 trading days, right? Moving average. Then you calculate, you add up all the trading days in that year, 200, assuming that says 260 days, and then you divide by 260, you get the 260-day average. Okay, so depending on the trend that you're trying to identify, and which I'm going to go through with you in a short while. Okay, the problem with the moving average is a universal indicator, right? Universal means I do not know what parameter to put in, right? I do not know what moving average to apply. Should I apply a 5-day average? Should I apply a 20-day average? Should I apply a 30-day average, 100-day, 200-day? So it can be anyone's guess, right? So we need to know how to put in those numbers. So the rationale behind a moving average is this. Okay, let's say the average price is the blue line over here, right? The blue line over here. Now, if the price is trading above the average, what does it tell you about the market? Okay, why is it that the average price, assuming let's say the average price is $1 here, all right, at $1. But instead of trading at the average price of $1, the price is being traded right now at 105, for example. Okay, why is it trading at 105? And it keeps on trading above the average price of $1. Maybe today 105, tomorrow 108, and then the next day it comes down to 106, right? And then the next day it goes to 109. Okay, it's always above the average. So what it simply means that the market sentiment is bullish, isn't it? Remember, the term bullish or bearish is a sentiment. Right? There are reasons why price trades above the average. There's a reason why price is bullish. Okay, simply because there's in economic terms, or when you look at price charts, it simply means that there are more demand and supply. Right? There are more people who wants to buy than people who wants to sell. That's the simplest explanation, right? And the price will keep on getting higher because the demand is always increasing, and because the supply is limited, the price keeps on getting higher. Okay, so if the price continues to be transacted higher than the average, okay, simply means that the market sentiment is bullish. But if the price continues to be transacted lower than the average, that means they're not bullish. They don't expect the price to go up, and that's the reason why they buy and sell at lower price, at below average price. So this is when the market is bearish. So simply put, when we put a moving average indicator in, right, if the price is above the moving average, we have an uptrend, and the price is below the moving average, we have a downtrend. Okay, so that's the simplest application. Now, next one. So remember, I told you about the moving average being a universal indicator. So there's no one figure which we can apply on all instruments that we are trading. Okay, on all stocks, right? But there are certain guidelines. Okay, so if I'm looking at a daily chart right now. All right, if you apply a 60-minute chart, then the definition would be different. If you apply a weekly chart, then the definition would be different as well. So here I'm looking at a daily chart. So anything that we apply that is below 30 days, which is roughly slightly more than a month, okay? Because when we put 30-day moving average, it means 30 trading days, okay, not including the Saturday and Sunday, if the market is not trading on Saturday and Sunday. All right, so 30 trading days. So this comes to about a month plus, right? A month and a half probably of trading. Okay, so anything that's below 30 days is like calculating a 1 month average. So that's short term. All right. Anything that's between 31 to 90 days, then it's medium term, and 91 days and above is considered long term. All right. So again, this is just a guideline. Right? Normally what I'll do is I put in a 30-day moving average and probably a 90-day moving average, and I use a long-term 200-day moving average. Okay, so the 200-day moving average is more like a yearly average, because 200 trading days, right, is almost a year. I think there probably be about like 240 to 260 trading days a year. Okay, now Malaysia probably is lower because we have a lot of holidays, right? So maybe you have more trading days in Singapore than in Malaysia. Okay, so this is just a guide, right? Now, let's take a look at the difference between the moving average indication. Now, remember, if the price is below the moving average, then we have a downtrend. If the price is above the moving average, then we have an uptrend. Okay, so here we have a 30-day moving average, which is the blue line, the blue dotted line, right? And then we have the 60-day moving average, which is slightly a longer average, which is represented by a light blue dotted line. And then we have a 90-day moving average, which is the red line or red solid line. All right. So if you look at this period over here, let me see. You look at the period on the left hand side, right? So you look at the price is below all the averages. Okay, it's below the 30-day, below the 90-day, below the 60-day moving average. That means it is a bearish trend. Okay, in both short to long term, right? So the price keeps on getting lower and lower. As long as it stays below the moving average, then the trend is still bearish. All right. Then we see the price start to rebound somewhere here on March of 20. The price start to go up. And of course, the first level where the first moving average it broke, okay, was the 30-day moving average. Because it's the shortest term one among the three moving averages, the 30-day is the shortest one. All right. So here, when the price goes above the moving average, it shows that the short-term trend turns into an uptrend. Okay, remember before this, it was a bearish trend, right? But the moment the price breaks above the short-term 30-day moving average, then here itself, it already starts to turn in an uptrend. Okay. But it has not turned into a medium-term uptrend yet, right? Because it is still below the light blue dotted line, all right? Now you can see that the price only start to go above the blue dotted line over here. Okay, so here, so the price have to move first, right? Because this is a trend indicator. So it has to continue trending higher, okay, until it proves that the price is able to go above the average. Then only the medium term starts to turn into an uptrend. Okay, so now we have a short term that's going uptrend. We have a medium term that's going uptrend, but it is still in a downtrend for the long term. Okay, because it's still below the red line, right? The red solid line, which is the 90-day moving average. But as price continue to go up, right? As price continue to go higher, and the moment the price goes above that red line or the 90-day moving average, then we see that the long-term trend has also started to turn bullish. So you see over here, if you put a short-term average, it gives you faster indication, right? Of course, if you put a longer-term average, you get more lag, right? Because the price, if you're looking at a long-term trend, for example, the trend has to develop quite strongly first before it becomes a long-term trend. So therefore making it lagging. So the higher the moving average that you put in, right, the slower you get, okay, on the indication of a trend. Okay, so when the price goes above this red line over here, that means now only the long-term has started to turn bullish. Okay, and at this price, of course, the price is above all the moving averages. So the short-term trend is up, the medium-term trend is up, the long-term trend is up. All right. So that's trend. So when we try to identify a trend, okay, whether it's a bullish trend or a bearish trend, we need to know which trend, okay, or which time frame or which which period of trend that you're trying to identify. Are you trying to identify a short-term one, or are you trying to identify a long-term one? Okay, like for example, if you look at this price here, if you put a long-term moving average, a 90-day moving average here, for example, you can see that the 90-day moving average, this whole chart here was going down, and most of the time the price is trading below this moving average. So the whole period here is in a long-term downtrend. But if you apply a short-term 10-day moving average, you can see that even if it's a downtrend, long-term downtrend, the trend can be bearish, it can be bullish in that long-term downtrend itself. Because if the price starts to go up shortly, then we have a short-term uptrend, and of course the price will be trading above that short-term moving average or the 10-day moving average. Okay, so in the downtrend, you can have short-term uptrend, short-term downtrend as well. Okay, and of course, this is a bigger picture. If you put a much bigger picture, for example, you put a 10-year or 20-year chart, and when you see a 10-year or 20-year chart, this chart may look a very small segment on the chart. Okay, because we may be able to identify a much bigger trend on a longer time frame. Okay, so the idea is this, right? When you apply a moving average, so again, back to the rule of thumb, right? If you apply anything that's below 30 days, then you are trying to identify the short-term trend. It can be 10-day, it can be 20-day, it can be 30 days, right? If you're identifying a mid-term trend or medium-term trend, okay, medium-term trend, then you apply a moving average between 31 to 90 days. Okay, if it's a long-term trend, then it has to be 91 days and above lah. Okay, so now when you apply the moving average, here is quite, I mean, look at this. This is very nice, right? Of course, I can pick the nice ones because these are all historical prices, isn't it? Now, notice if the price is above the moving average, then we have an uptrend. Okay, but the moment the price goes below the moving average, we have a downtrend. And then once it goes above the moving average, we have an uptrend again. Right? So again, historically, it's easy to identify them, right? Because this is historical. So I can actually pick the best moving average to put in. I can even, in fact, even just look for a chart that looks good here on the moving average. To just give you an example, right? So when you look at moving average, it simply works very well in trending markets. Okay, that means when the price trends, as you can see here, the trend is very well defined, right? It goes up nicely and then it comes down. Also, it comes down to a downtrend. And then once the price goes above the moving average, then it goes in an uptrend and keep on staying above the average. And we can expect the trend to continue. Okay. So now, like I mentioned earlier, it is always easy to identify trends when they are already historical, right? Because you can always select which one you don't look at, all right, or which indicator you want to put in, because those prices are already history. Okay, but the most important question, right? The most important question is this part of the chart which we don't see, which is the right-hand side of the chart, which is still blank, right? Because this is where we're gonna make decision moving forward, not the historical prices, but right now, the last price on the chart, which is on the right. Okay, and when we look at this direction, we all know is an uptrend. Okay, you can see the price is above the moving average, or even if you don't apply the moving average, we know that the price is going up in an uptrend. But the question is, right, the $1 million or the $1 billion question is, can this uptrend continue to go higher, or it will turn the other way around? Okay, so how can we confidently know whether this trend is going to continue going up like the green arrow, or is it going to turn downwards? Okay, so that's the most difficult question. So the bulls are charging right now, right? We all know that the bulls are going up. It's stronger and stronger and stronger. But how do we catch them? All right, or in fact, are the bulls still running? Okay, so how do we know? Remember, I told you about the second characteristic of price trend is the momentum of that trend. Okay, I want to know whether we still have momentum, we still have legs, okay, whether the bulls still have strength to go up higher. Okay, so how do we know that? Now, this is where the moving average is lacking, right? It is good at identifying whether the trend is going up or down, and of course, it's flexible. You can put in the parameter to identify whether you're looking at a short-term trend, medium-term trend, or long-term trend. Okay, but there are setbacks. Okay, now one of the setback, of course, it is slow. All right. Now here, for example, okay. Now let's say if the price is in a downtrend, that means if the price is below the moving average, of course, I will not buy lah, because it's not is going down, isn't it? Okay, then I tell myself, you know what? If the price starts to turn upwards, then I'll start buying. If the price starts to trend upwards, then I'll start buying. So now you notice here on the price, right? On the left-hand side, the price keep on going lower, 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 and lower. All right, let me just turn on the laser pointer here. Okay, so here we have prices going lower, lower, and lower. And then here's a downtrend, right? Because the price is below the moving average. So what we want to do is we want to wait for the price to turn upwards and go above the moving average to tell me that the price is turning bullish. So if the price has to go up like 1, 2, 3 days, after 3 days, then only your price goes above the moving average. Then I tell myself, you know what? I think I can buy here. And then the price starts to go up. Okay, now notice this, the thing that you only get an indication like from the first bottom, second bar, third bar, fourth bar. The fourth day from the bottom, then only you get indication to buy, right? And when the price really go up this level, we'll be thinking to ourselves again, can still buy, right? Because the price is going up higher, right? The lowest price was here. I will tell myself, you know what? I should have bought here. Okay, but now the price has gone up. Okay, maybe it has gone up 15, 16%, or maybe even 20%, right? From the bottom before you get the moving average telling you that, oh, you know what? It's turning into an uptrend. Do you want to continue to join or not? Okay, so it's a little bit lagging, right? Of course, if it's better if you want to buy at the bottom, right? But here we will not be buying at the bottom. So if we use a moving average, we will never be buying at the bottom. We will only be buying in an uptrend, for example, if the price starts to develop an uptrend. And that's when the price starts to go above the moving average. Now, same thing when it comes to sell, right? So when the price is above the moving average, okay, I'm expecting the price to go upwards. Now, remember, if let's say I point the data here at the top here, right? Now, at that point, whatever that's on the right, you don't see yet. Right? You can't see this part over here. You can't see this part of the chart. You only see here because that's where the price ends. That's where the current price is. Okay, and that point of time, it looks like, wow, the price is really going up higher, isn't it? Okay, and it's above the moving average. Okay, and then the next day the price came down. Okay, so again, if I put a pointer here, whatever that's on the right hand side of the pointer has not existed yet. Okay, this is still a blank chart. This is still empty. But what we see is price coming down. And then what do we do, right? Should we sell because the price has gone down quite significantly over the past 2 days? Okay, possibly 15 to 20% from the high. And be asking ourselves, should I sell now? But the price is still bullish, isn't it? Because it's still above the moving average. Okay, and the price came down a little bit. It's still above the moving average. It rebounded a little bit. And finally, it went below the moving average. You know what? Then it says that now the price is turning downtrend. Okay, and then I make a decision now, since that the price is not in uptrend anymore, then I will sell. Then I'll sell over here, right? And you notice that whenever you make a decision based on the moving average, right, to buy and sell, it's lagging. It's never at the bottom. And sometimes, like I said, if you put a longer term moving average, for example, you put a 90-day moving average, the price probably have to rebound maybe 30 to 40% from the low before it goes above that 90-day moving average. All right. So in nature, it's lagging. Okay. So normally I will not use the moving average to make a buy and sell call or decision. Okay, but I will use it as a supporting indicator. Okay. I'm going to use moving average to just tell me what's the trend. But of course, as time develops, you discover more indicators. I will have better indicators to use. Okay. Another setback is that parameter is not fixed, right? 10-day, 20-day, 30-day, I do not know which parameter to put in. Okay, that's a problem itself, right? Now, the third one, which is the important one, is that it does not indicate the strength of the trend. I do not know whether it's strong or weak. I only know that it is up or down, that is bullish or bearish, right? If the price is above the moving average and keep on trading above the moving average, then it's bullish. And if it keeps on trading below the moving average, then it's bearish. Okay, simply put, right? So if I use the moving average indicator, then I would not know the strength. Okay, it is important to know the strength because, like I mentioned to you earlier, if it's a strong trend, then the trend is likely going to continue. If it's a weak trend, then that trend is weak. That's why it's weak, right? The word weak. then I do not expect the trend to continue. Okay, so that's a setback, right? Now, more recently, we have probably learned about this indicator called the Ichimoku Kinko Hyo. It's the name itself tells you that it's from a Japanese, right? And there are actually quite a lot of Japanese indicators and also Chinese technical indicators. Okay, but because most of these are written in Japanese, right? Most of the indicators, Japanese indicators, are being written in Japanese. Only until recently they are being translated. Then only people who are like you and I who do not know Japanese would be able to use it. Okay, and this indicator is not new. Okay, this indicator has been used for a very long time. Okay, let me introduce you this indicator, right? So if you look at this, so again, the Japanese word Ichimoku Kinko Hyo simply means an instant view of a balanced time and price chart. Okay, now you have to look at it. This was developed in 1930, and that time there is no charting software. In fact, there's no computer as well. There's no personal computer existed at that time as well. Okay, and of course, this indicator is only published like 39 years later, which is 1969. In Japanese, only in the 20th century, the 1990s, then only is being translated into English, and that's where we are able to understand it. All right. So it is created by this guy called Goichi Hosoda, and he used spreadsheet, right? Remember, there are no charts at the point of time. So it's basically just a piece of paper, not even Excel spreadsheet, right? There's no Excel spreadsheet at the point of time. It's just a piece of paper where he write all the numbers, and every day the data comes in, he just put in the data in. So you just see a set of numbers, all right? And from the numbers, okay, when you look at the numbers, he want to visualize a chart. Okay, so by looking at the numbers, it's like now you're going to the metrics zone, right? When you look at all the numbers and then you can see a picture. Okay, so same thing like this guy. So this guy probably is in the metrics, right? I do not know. Okay, but so what he does is when he look at those numbers at one glance, he can visualize a chart where the price was previously and where is the price going to be in the future as well. Okay, by looking at spreadsheets. So by wanting to have that view, he needs to calculate a few data points. It's quite a number of data points actually, right? So like here, for example, the foundation of this indicator is based on this. I do not even want to attempt to pronounce this Japanese name because I do not know I'll get it right or not. But we normally just call it a standard line and a turning line. All right. So what this guy basically wants to do, right, is to identify first of all a moving average, or calculate the average calculation. Right now, of course, remember that point of time they got no charting tool, right? You only have a spreadsheet, and he has to have an easy way to calculate average. Okay, so the easiest way to calculate average is by looking at the median prices. That means you just take the highest price and the lowest price. Okay, you divide by 2, and then you get the middle of the highest and lowest price over the last 9 periods. Okay, so you're looking at 9 days average. So 9 days is short term, long term. Okay, anything is below 30 is short term, right? So it's a 9-day average. That's 1. Okay, I need to look at also a slightly longer term average. All right. So here he uses a 26-day average, and that forms the turning line, right? So the turning line, the second line, is basically a 26-day average. So it's basically simply like applying a 9-day and 26-day average on your chart, and that forms the standard and turning line. Okay. Now, so this is the foundation. This 2 line is the foundation. Now, this is where it gets more interesting, right? Here we have the span A line with the first preceding span. It's called preceding. I'll explain in a short while. Okay, why? Because it is not plotted today. Whatever that is calculated today's data point is not plotted today, but it is plotted 26 days to the front. Okay, so the first span A is the average between the 2 lines. Okay, that means you take the standard line plus the turning line, you divide by 2. So it's the average between the 2 lines. Okay, and you plot 26 days to the front. That forms the short-term trend moving forward. Okay, because remember 9 and 26, right? It's below 30 days average. And now it's an average between the two lines. Okay, so it's still short-term in nature, and it's being plotted 26 days to the front. Now, the second span B, or the second preceding line, okay, is a 52-day average. So we are looking now at the midterm average. Okay, so it's basically, again, the average calculation is simple, right? You take the highest high and the lowest low. That means the highest point and the lowest point over the past 52 days. You divide by 2 to get the average price. So it's actually a 52-day average and plotted 26 days forward ahead. All right. Now, these are all derivatives, right? So the Kumo or cloud, okay, Kumo is translated as cloud. The cloud is the area between the preceding span A and span B. Okay, the cloud is basically the most important indicator, or the most important tool in this particular indicator, and I'll explain to you why in a short while. Okay, now then we have a Chico span, right, which is actually a delayed line, and this is actually just a today's closing price, but it's not plotted today, it's plotted 26 days before. Okay, remember I told you this guy wants to look a balanced view, right? So that's why you need the data, today's closing, but where it was 26 days ago, and today's average, and where is it going to be 26 days later. So to get a balanced view, all right? But of course, today with the help of charting tool, okay, you don't really need all these lines or all these data points on your chart, all right? Because immediately when you look at today's price, you know where the price was 26 days ago, all right? But what we do not have is basically what is possibly going to happen in the future. And that's the beauty about this indicator. All right. So remember, when we apply the moving average indicator, it only indicates us the trend. Okay, whether it's an uptrend or downtrend, stop. That's it, right? The Ichimoku Kinko Hyo, or the Ichimoku cloud indicator, is able to tell you the trend. Okay, not only that, it's also able to tell you the strength of the trend, okay, which I'm going to explain, and also what could possibly be the future trend. Okay, so 3 indications with 1 indicator. Okay, it's like 3-in-1 indicator lah. All right. So I'm going to explain now why is it 3-in-1. Okay, so when you apply the Ichimoku indicator, this is what you get, right? You get, remember, the cloud. Okay, the cloud is the area between span A and span B. Okay, and then we have the standard and turning line, which looks like a moving average. You can see the line is following the price, right? So you see the blue line. The blue line is basically the standard line, because that's the shortest term moving average, which is a 9-day average, right? The turning line is 26 days, so it's further from the price. Okay, and then we have the delayed line. This delayed line, this dotted one here, is basically just today's price. Okay, but it's just plotted at the back. Okay, so first of all, we don't really need a delayed line, because on the chart itself, we can already see where the price was 26 days before. All right, so we don't really need this delayed line. It's useless lah, basically, right? But for that guy, it's useful, because remember, he's looking at numbers only. But here, we are looking at a chart. All right, then we have the standard line, turning line, and of course, the cloud. And of course, the cloud is a derivative of the standard and turning line. Now, so how do we use this indicator? Like any trend indicators, right? If the standard line is above the turning line, remember, the standard line is a short-term average, the turning line is a longer-term average. So it's like price against average, right? So if the price is above the average, and in this case, if the short-term average is above the long-term average, we have an uptrend. Okay. So when the standard line crosses above the turning line, that means when the 2 lines cross above, it means that the price is reversing upwards. Okay, but now notice this, right? It doesn't matter whether, if it cross up or down on the standard or turning line. Okay, but you will only get a confirmation of the trend, or in this case, a confirmation of an uptrend, when the price close above the cloud. All right. Of course, in order for it to turn and go above the cloud, first of all, the standard line have to cross above the turning line first. If not, that will not happen. All right. So the decision maker here is the cloud, right? If the price is above the cloud, we have an uptrend. So the standard line crossed below the turning line. That means the price is reversing downwards. The short-term average is now below the long-term average, and therefore the trend is reversing downwards. Okay, but it is only confirmed when the price closes below the cloud. Okay, so one of the reasons why the guy calls this a cloud is because you probably heard of this if you learn about this indicator, right? But the reason why it's called a cloud is because now imagine if we are flying, right, in an airplane, okay, and we are flying in a stormy weather. Okay, so if we are flying below the cloud and there is a storm, we will get turbulence. It's not a good sight to see, right? It's not a good place to be. Okay, when we are flying below the cloud and it's in a storm. Okay, and normally if that happens, the pilot will try to bring the plane above the cloud. Why? Because the storm is only below the cloud, right? So when the plane goes into the cloud, the pilot can't see, right? He only have to basically depend on his indicators on the plane to give him direction. But when he goes into the cloud, literally you only see like smoke all over. Okay, but the moment it goes above the cloud, suddenly you see everything is clear. You see the storm below the cloud, but when you go above the cloud, you see the sun, right, or the moon, and everything is clear. So simply put here, right, that if the price is above the cloud, everything looks good. It's rosy. That means it's bullish, right? If the price is below the cloud, that means we are in a storm. It's a bearish market. The sentiment is bearish. If the price is in the cloud, it simply means that it is directionless lah. There's no direction. Okay, you can't see direction. Okay, so that's why the indicator is named as the cloud. All right. So here again, we look at price going in a downtrend. You can see that the price is below the standard and turning line. But the moment the price goes above the standard and turning line, and the turning line goes above the standard line, then we have a reversal in a trend. But because it is still below the cloud, okay, the trend is not confirmed. Okay, so it's a little bit more lagging right now because if you remember, one of the preceding span is actually a 52-day average. Right, that's why it's a little bit more lagging. Okay, so the uptrend is only confirmed the moment the price closes above the cloud. So you have to wait until the price closes above the cloud to get a confirmation. All right. Now the good thing about this, sometimes it's better to make a wait a little bit longer is because we want to go through what we call a period of whipsaw. Okay, that means that the price can go up a little bit, but eventually it's going to come down again, and it's going to go up again and going to come down. I'll show you some examples later on whipsaws, right? And when that happens, when the price goes up, it looks like it's going to turn bullish, but then it turns back down again. Then we have to sell, right? And then after it starts to turn upwards again, it looks like it's going to turn bullish. The price goes above the moving average, like what happened here in an uptrend reversal. It looks like it's going to turn bullish. And when we buy, then the price turns down back again. It's basically going sideways, right? So when the price cuts the indicator, in this case, the moving average, very frequently, okay? This week, it goes above the cloud, it goes above the moving average. Next week, it goes below the moving average. Then the following week, it goes above the moving average again. That's called a whipsaw. All right. So in order for us to go through that whipsaw, okay, we give it a little bit more time, right, for the whipsaw to be over, and therefore it's getting more delayed, lagging, a little bit more lagging. Okay, and for Ichimoku cloud, okay, the moment the price goes above the cloud, it simply means that the storm is over, and we're going to expect the price to turn bullish. Okay, so this is a very simple indicator right now. Okay, now because the decision maker, right, is the cloud, right, we don't even need these two lines anymore. We don't even need the standard and turning line. All you need is basically this cloud. All right. So very simply put, if the price is above the cloud, is bullish. All right. and if it's below the cloud, then it is bearish. So simple as that, right? So we don't need to look at whether the moving average, because if you use moving average, even moving average, sometimes the price can cross the moving average and cause whipsaws, right? But because if you use a Ichimoku cloud and you notice that the price or the Ichimoku cloud give the price a lot of room to move, right? So even if the price goes sideways like this, it is still considered an uptrend because it's still above the cloud. So it gives a lot of room to move. But the moment the price goes below the cloud, that means it's over. All right. So if you look at the current price, you just look at the price alone, right? We know that the price is in a bearish trend, right? Because the location is where the price is below the cloud, isn't it? Right. So it is in a stormy weather. So it's like the plane flying below the cloud. Right? So we have a bearish trend. If the price is above the cloud, then we have an uptrend. Okay, so the first thing you want to do is to identify whether, first of all, is the price above the cloud or below the cloud, right? If it's above the cloud, then it's an uptrend. If it's below the cloud, then it's a downtrend. So that's trend identification. That's what moving average can do as well. Okay, but of course, we're not going to stop there, right? Because now we're going to take a look at the cloud. You can see that the cloud sometimes expands and then it gets thinner. It expands and it contracts, it expands and contracts. And you can see that the cloud sometimes go up and sometimes it can come down as well. Okay, so what does it indicate, right? It's not an indicator to just tell you the direction, okay? The other thing that it can tell you is basically the strength of the indicator, right? Now, direction is determined by the location of price against the cloud. If it's above the cloud, uptrend. If below the cloud, downtrend. Then you look at the thickness of that cloud. All right. If the cloud is thickening, that means it's getting thicker and thicker and thicker. It simply means that the trend is getting stronger. Okay. It doesn't tell you direction. It just tells you whether it's weaker or stronger. Direction, it depends on whether the price is above or below the cloud. Right? If the cloud is getting thinner, okay, it simply means that the trend is getting weaker. Okay, so here, instead of just telling you whether the price is in an uptrend or downtrend, your analysis can go further. All right? In an uptrend, that uptrend can be weaker or stronger. And in the downtrend can be weaker or stronger. Okay, so bullish trend, remember, this is when the price is above the cloud, right? Bullish trend. Okay, so what makes the cloud or what makes the trend strong is whether the cloud is expanding or whether the cloud is getting thinner. So strong bullish trend is when the price is above the cloud and the cloud gets thicker. All right. If it's a weak bullish trend, the price is still above the cloud, but the cloud gets thinner. Okay. Now, if it's a bearish trend, price is below the cloud, and if it's a strong downtrend, the cloud gets thicker. Okay. If the price is below the cloud, you have a bearish trend, and if the cloud gets thinner when the price remains below the cloud, that means that the bearish trend is weak. Okay, so this is basically how we apply the Ichimoku indicator. And now, not forgetting that this indicator is not plotted, the cloud is not plotted until today. It is plotted 26 days to the front, and therefore letting us know whether the cloud, whether the trend is going to get stronger or weaker, at least in the next 26 days. So this guy is a little bit smart, right? He tried to identify the current trend movement, the characteristic of the trend movement, and from the current trend movement characteristic is try to predict or try to forecast what can possibly be the next trend by looking at the current data movement. So it's like analyzing today's data to try to do a forecast into the future. Now, bear in mind, but again, to give a word of caution, it does not, of course, happen 100% of the time, lah. All right, there is no. If you still remember, I mentioned many times that there is no indicator that's going to give you 100% accuracy all the time. All right. If Jason right there can have an indicator that's 100% all the time, then he will just what you always say, just go all out, okay, whack. Because now imagine you have one indicator that gives you 100% probability, right? That means you know that this indicator show make money one. Okay, the moment you buy, when you have an indication, you buy show make money. Now, if I know I only need one time to get right, because I'm just going to go silent, I'm just going to go all out, just to one trade, and that trade show make money one. Enough already lah, right? If there is 100% certainty. So, you know what? There is no such thing as 100% certainty lah, all right? But it's good enough to actually identify. And of course, this is an indicator that you can use together with other indicators to give you a better picture. All right, I'll give you examples later on. So now if you look at this particular trend, right, this indicator here, now number one, what's the direction? Okay, maybe you guys can answer this lah. Quiz. Unfortunately, I don't have any prizes to give. Okay, what's the trend direction? Okay, you guys wanna try to answer? So today is educational, right? Okay, later we'll take a look at Singapore stocks and how you apply this on Singapore stocks. Anyone wanna attempt? You have nearly 200 people over here. Don't tell me one person also don't want to try to answer. Don't worry if you get it wrong lah, because you're not going to lose money now. Getting wrong here, right? Yentong prices 4-digit number will do. So what's the trend? What's the trend direction right now? Okay, even if you don't apply, if you don't put an Ichimoku indicator, you know that the trend is going up, isn't it? So yeah, thank you, Kevin. Thank you, Peka. Thank you, Alex. Thank you, Winky. All right. So if you look at that particular trend, right, it's an uptrend, right? So first thing, direction first. Okay, you have to establish the direction first. So clearly, it's an uptrend. Now, second one, right? Is it strong or weak? You look at the current price. You don't look at the cloud moving forward. You look at the current price and where the cloud is. Is it weak or strong? Okay, Winky say it's a weak uptrend, but KP Chin says it's a strong uptrend. Okay, what about you guys? At that point, at the last data that you see there over there, is the cloud expanding or is the cloud getting thinner? Okay. Yeah, strong cloud. Yuan Tong says strong cloud. And why is it strong? Is because if you look at the cloud, it is expanding, right? Expanding. Now, if you really want to know why it's expanding and why it's contracting, if you like numbers, you look at the formulas. All right. Basically, right, I'm just gonna explain to you if you can understand, right? Is that when the cloud is expanding, it simply means that the 9-day average, okay, and the 52-day average is getting wider. The rate of change, remember I told you momentum, right? Momentum is about rate of change. The rate of change between the short-term trend and the long-term trend just gets bigger, and that's why it's strong, right? If the rate of change between the two lines, both of them are still going up, but they're going up at the same level, right? That means there's no higher rate of change. There's no change at all. Both for the short-term trend and the long-term trend is moving together. But if one moves faster than the other, and normally the short-term one that moves faster because it's short-term, right? Then we know that the rate of change is bigger, the momentum is bigger. So basically, the cloud is actually a momentum indicator of the uptrend or the downtrend. Okay, the momentum of the trend. Okay, so that's why you see when the trend is expanding upwards, that means we're expecting the trend to be strong. Okay, so first answer, you already know the trend direction is up and the trend is strong currently. Okay, currently is strong. Now, the third one, you can also see whether the trend is expanding moving forward. Okay, it's plotted up to the next 26 days. So moving forward, do you see a strong trend or a weak trend? Number one, look at the direction first lah. Direction is going up, right? So we're gonna expect a strong uptrend. Okay. So the future trend direction here is also strong upwards. It means that after a correction, after a pullback, like what we are seeing now is price going down, it's pulling back, right? And when the price starts to rebound and continue its trend, we're going to expect the price to go higher. Now, remember the term about continuing its uptrend is basically price breaking the previous high. Then only the trend can go higher, isn't it? All right. So simply say that, simply put that if the price, okay, which is currently down here, is really pulling back for a correction, right? So although the price pull back for a correction, but the trend indication from the Ichimoku clouds still say that there is still room for the price to go higher moving forward and possibly break the previous high over here, because they're going to expect the trend to continue. So with that, with this indication, then at least I'll now be looking for opportunities to buy when the price pulls back, as compared to a weak trend. So if the trend is weak, if the momentum is really weakening, if the price pulls back, then I don't even want to bother to buy. Okay, so by using this indicator, right, simply basically able to identify or just edify your pullback strategy. That means the price is correcting now. Can I buy or not? All right. If the price is correcting and the trend is weak, then forget it. If the price is correcting downwards, but the trend is still strong, then I will consider buying the dip. All right. So this is an indicator that you can use to basically give you a broad view of the trend. Okay, whether you should go with it, whether you should go with the trend, or whether the trend is going to die, it's going to turn the other way around, whether you just abandon it. All right. So that's what this indicator is all about. Okay, now if you look at this particular trend, now how do you interpret this chart? So again, you have to answer the three questions, right? Number one, direction of the trend. Number two, the strength of the trend. Number three, future direction. Where do you expect it to go? Okay, anyone want to try? So three questions, right? Trend direction. What's the current momentum? What's the current strength? And what's the strength moving forward? Three. You have to answer these three first. Maybe you just want to type it down if you can. I'm going to give you some time, maybe time for me to just take a sip of water first. Anyone? So after this, you guys can actually be a trend expert lah, right? By just applying this one indicator alone, it can tell you quite a number of things, right? It can tell you the direction of the trend, it can tell you the strength of the trend, and what to expect moving forward, okay? At least in the next 26 days. Nobody wants to try? Down, weak, future, strong. Okay, fantastic. Downtrend, momentum reducing, price drop further. Okay. Next. Anyone else? Thank you, Yuan Tong. Thank you, Chin. Thank you, Calvin. Okay, Peika. Downtrend. Okay, everybody got the trend correct. Like strong bearish trend. Okay. Okay, interesting, right? So now, of course, after today, you need to do more studies about this, right? So I'm just going to give you how I will interpret this chart. Okay, so if there's nobody else want to attempt, then let me give you my answer, all right? So now, number one, very simple, right? Trend is down, so everybody got it right. The trend is down, except for Yuan Tong. Yuan Tong, I don't know why you see an uptrend. Oh, sorry, this is a previous one. Okay, KP Chin down week. Calvin says downtrend. So all of the three of you said downtrend, so it's correct, right? Now, if you look at the current downtrend, weak or strong, so if you say it's weak, it's correct, because if you look at that point of time, right? At that point of time here, okay, this is the current data, right? This is the current data. You can see that the cloud is actually narrowing. All right. So if it narrow means what? Narrow means that the price trend is weak. Okay, so weak. All right. So it's a weak downtrend. Currently, it's a weak downtrend. And that's the reason why we see the price is rebounding, isn't it? Because it's a weak downtrend. Okay. If it's a strong downtrend, the price would have gone much further downwards. All right. Now it's a weak downtrend, the price is going up. Okay. Now the future part is where it's important, right? Because this is where we want to know whether the price is going to continue going downwards or it will turn upwards. Okay. Now if the price is currently near the cloud, which is currently is, right? That means the price can either break above the cloud, because remember, if it goes above the cloud, it means that the trend is turning bullish. All right, it's turning bullish. But if the price fails to go above the cloud, because it's quite near the cloud right now, it's quite near to breaking above the cloud, and it's a thin cloud, it's very easy to break one, right? If the price stays below the cloud, okay, if it stays below the cloud, what does it mean? So if you look at moving forward and it stays below the cloud, then we're going to expect the bearish trend to continue going lower. A strong bearish trend, because the cloud is expanding, moving forward. All right, that if the price does not go above the cloud. So what it gives me here, because this is a downtrend, right? This is not an uptrend. Okay, it gives me an opportunity to go short. Right? Why? Why go short now? If I'm going to go short here, okay, and if let's say the price continues to stay below the cloud, then I'm going to expect the trend to turn downwards and go lower, and I'm going to profit from my short position. Okay. But if the price rebounds above the cloud, then I have to exit my short, because the price is not going down, right? It's going above the cloud, and therefore the price is turning upwards. So I get out fast. So the good thing about this is, if the price goes above the cloud, it just has to go up a little bit before I exit my short position, and therefore my risk is low. Okay, but if the price cannot go over the cloud and go downwards, my potential profits can be big. Okay, so of course, in a downtrend, if you're trading stocks, we can't go short. But if you're able to go short, then this is a good opportunity to go short. All right. Now, the other question is this. What if I do not want to go short? Because if the price goes above the cloud, it means time to buy, isn't it? Right? But if the price goes above the cloud, what's the direction of the cloud? Okay, the direction of the cloud is still going, is a red color, right? You can see there's a difference here. So if the price goes above the cloud, although the price may go above the cloud, but we probably would not see the price trending higher, because moving forward, the cloud is now in a red cloud. So in this case, the probability of getting a good trade is buying going short, because number one, you are buying at a low risk shorting opportunity, okay, with very high potential profit if the price falls, but very minimal risk. And your risk is when the price immediately go up above the cloud. Okay, so the opposite can be said for a bullish trend. So later we'll take a look at bullish trend for Singapore markets, right? Yeah, the cloud has different meaning. Remember, we have preceding span A and span B, right? Okay, span A is the difference between is the standard and turning line moving average plotted 26 days to the front. So standard is 9 days, 26 days is the turning line. So it's a short-term average. All right. And if it's an uptrend, normally the short-term average will be above the long-term average. The preceding span B, the second line on the cloud, is basically a 52-day average plotted forward. All right. So the green one, the green area means, right? The green area means that the short-term average, the span A, is above the long-term average span B. Okay, the short-term average span A is above span B. If it's red, it simply means that span A, the short-term average, is below the long-term average. Okay, that's simply it. All right, that's the difference. Okay, Alex, Calvin. So basically, the bias of the trend is downwards if the cloud is red lah. If it's green, then the bias is upwards. Okay. But of course, when the price starts to go above the cloud, then the cloud characteristics in the future may start to change as well. Okay, but that if the price goes above the cloud. But if the price remains below the cloud will continue to be thicker. All right, thicker, and as long as the price trades below the cloud. Okay. All right. So what I'm going to do now is I'm going to show you another table here. I'll answer your question in a short while, Wilson. Okay. So what I'm showing here, I actually did a scan. When the market closes today, this is as of 13th of April, which is today. Right, these are counters where price is above the cloud. Right, there are a total of about 300 counters, 297 counters, including ETFs, warrant REITs, or it's everything lah, right? The total number of counters being scanned is about 1,600 counters because we include warrants and all that, right? So there's about 1,600 of them. So 300 out of 1,006, 70%. Okay, so I'm just going to use my calculator over here. 300 divided by 1,006. Okay, it's 19%. That means 19% of the stocks in SGX is currently bullish. Okay, 19%. So the other 80% is below the cloud. All right, and this is basically based on my data lah. Yeah. So I've already sorted this by the value of the contract or the stock being traded today. Right. So we have this is the current price or the price closed today. SIA is 553. This is the cloud. So the cloud is at 488 currently. So that means the price is above the cloud, right? For DBS, the current price is 2884. The cloud currently at 2698. So it's all of these counters here is where the price is above the cloud. All right, and then here we have the volume and we have the value. So today the highest traded value stock, right? Value means price times volume lah, is SIA. Okay, the volume is 14 million. Okay, Sembawang Corp here have 183 million shares being traded, but because it's only a 20-cent share, and therefore the value is lower. All right. So these are stocks. So we have SIA is above the cloud. We have DBS is bullish, SPH is bullish, OCBC Bank bullish, UOB bullish, Singtel bullish, SGX bullish, and so on and so forth. These are all bullish counters. Okay. So the question right now is, I know that the price is being bullish, but when do I buy, isn't it? Okay. So I'm just going to take a look at SIA, for example. Okay, let me go and put in my chart here first, yeah. Okay, before that, maybe I'll try to answer some of your questions first. Okay, Wilson says, how do you interpret what happened on April 15? April 15 is here, right? So April 15, at that point of time, the trend is down, right? The cloud is quite thin, but it's still expanding. That means it's still a strong downtrend until the price crosses above the cloud. Now that it has turned uptrend, okay, but that uptrend is considered weak because the cloud is still red and but it's getting thinner, right? So it's considered weak until it turned green over here. Then here it says that the trend is now turning strong. So as long as the price is above the cloud, that trend is still in uptrend, okay, until the price goes below the cloud. Okay. So the thing is that when the price is above the cloud, we need to identify where is the opportunity to go in. Okay. Calvin, do you use any screener to produce a cloud table? If yes, what setting do you use? Okay, I simply use a software called Metastock, right? It's the software that I use since the beginning lah. Okay, it's a software that I use since the beginning. It's a very old software. It's used to be owned by Reuters, right? Oh, sorry, it's currently owned by Reuters or Refinitiv right now. Okay, so I use that software as an end of day based software where I do my scan. So I just set a price. I set a scan where the price is above the cloud. That's all. The indicator is already there. All you need to do is set the filter or the screener where price is above the cloud. Okay, so now let's take a look at SIA. Hold on, let me see whether it's a correct one. No, not this one. Hold on. Okay, yeah. Nope. Sorry, I got two charts going on here. Let me just remove one first. Okay, there you go. So, okay. All right, so now you can see my screen, right? So you have SIA over here, right? So SIA, if you look at the current price, is above the cloud, right? Definitely it's above the cloud. But the question is, can you buy at this price, lah, right? So now the best time to buy is when price pulls back. The question is, pull back to where, isn't it? So we want the price to pull back to near the cloud. All right. Now, for example, let me just go back a little bit. Let me go back here. Okay. Okay, this is in November. Okay, up to 2020 November. You can see the price is just trading below the cloud, below the cloud, below the cloud, below the cloud. And you know what? If we can short SIA, for example, right, the moment the price goes near the cloud or in the cloud, because it's really going inside the cloud, right? We are able to go short here. Let's say we look at this point here. I hope you can see my pointer. I just circle around here, right? Here. And that point of time, you can see that the cloud is expanding downwards, isn't it? That means we're expecting the price to continue going downwards as long as it stays below the cloud. So if I short here, my risk will be low. Why? Because if the price comes down and continues downtrend, I'm going to make good money or good profits over here. But if I'm going to short here and the price rebounds above the cloud, immediately I cut my losses. My losses will be very small. All right. So the best time or the best opportunity, where the low risk opportunity, is when the price goes to the cloud in an uptrend. In this case, where our bias is only to profit when the price goes up, where we can only long, we can only buy, right? So this whole period here, when the price, you see, when the price goes to the cloud, it comes down back again. So if you keep on shorting when the price is near the cloud, you can make good profits, right? Until here, when it breaks out, right? You can see that in 10th of November or mid-November, the price starts to go above the cloud. Okay, now the price has turned into an uptrend. Okay. But again, so when the price turns in an uptrend, it doesn't mean that we have to catch at the bottom sometimes, right? To actually ride the trend. Sometimes we can catch the trend in the middle of a trend or middle of a developing trend. Now, for example, let's say the price already break out, right? In November, the price was trading below 350 at 10th of November. Okay, from 350, and let's say the price has already gone up to $4 right now. So 350 to $4 is quite significant, right? That's more than 20% increase. So the trend is really going up, and you can see, right? At that point, the trend is still considered weak. I have to use this tool here. Hold on. Okay, I have to basic. Oops. All right, I have to basically block this thing lah. Okay, so let's say look at this level over here, right? Now, assuming that we're looking at this price, the price has gone above the cloud. Okay, but we don't see this part yet, right? The right hand side of the chart. But here you can see the cloud moving forward, right? Because the cloud is basically plotting moving forward. So the cloud is still thin. So that means although the price has turned in the uptrend, at that point of time, the trend is still weak. All right. But as I basically have to cover 26 days. Let me see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 2, 3, 4, 5, 6. Okay, I have to cover all this. Okay, so now if you look at this, the price, okay, is above the cloud, and because remember this one, the cloud actually is plotted forward, right? And you can see that moving forward, because the price has already gone above the cloud starts to turn green. Right here, it starts to turn green. It means that we're going to expect the trend to continue going up, okay, as long as the price is above the cloud. So as we move forward, right? Okay, let's say the price peak here at this high. Okay, and this is where you look at the price currently. Okay, so let's say the price has gone up. See, and you can see the price is trading at this price. The cloud is at the bottom here, so it's very far from the cloud, right? And if it's very far from the cloud, and if you buy at the current price, okay, if the price pulls back for a correction, your risk can be big as well, all right? Because the price may pull back to the cloud. And even if it pulls back to the cloud, it doesn't mean that the price has gone into a downtrend, right? If it can come down to the cloud and still above the cloud, it is still considered an uptrend. So buying at very high prices expose you to higher risk, because if the price do correct downwards, then you may be in trouble. Okay, so the best is wait for what? The best is to wait for the price to pull back to the cloud. Okay, like in this case here, as the time goes, you can see the price is now trading near the cloud. Now, why this is the best time, right? Now, I'm going to again cover this. You can't see the price. Okay, but you see moving forward is that the price is basically, the Ichimoku cloud is expanding upwards, right? So I will be expecting the trend to continue as long as the price is able to stay above the cloud. So now what happens if, let's say, I buy here lah? Okay, number one, I know that the cloud is expanding upwards, right? Don't see this part yet lah. You're not supposed to see the prices lah. But I cannot hide this, because if I hide the price, I also hide the cloud. But you can see that the cloud is expanding upwards, right? So if I'm going to buy at this price, number one, at least I did not buy the price when it was trading at 460 high, the highest level. It went into a correction and now it's 420. So now the question, right, in the pullback like this, is the price going to continue its uptrend? Okay, so I know right now that the price can continue its uptrend as long as it stays above the cloud. So stays above the cloud means what? That means if you look at the cloud, the bottom line of the cloud at that point of time, yeah, is here. That's the bottom, isn't it? All right. So that means if the price closed below, in this case, $4.03, that means it's not an uptrend anymore. I better get out. So now you do the calculation, right? So let's say you buy at 421, okay, and you put a stop loss at $4. So that means you have about $4 lah. Right? So that means you have a 21 cents risk per share buying at the current price. That means if the price, if you buy at 421 and it goes down and goes below $4, then I'm going to cut and take my losses because I do not want to hold when the price goes into a downtrend. Okay. But if it's able to stay above the cloud, if it's able to stay above 403, okay, then I'll expect the trend to continue after this correction is over. And remember, if the trend were to continue, it should break the high, isn't it? Okay, if this trend was going to be strong, it's going to at least break the high. So I have to calculate again, right? If I'm going to buy at 421 and if the price goes in an uptrend, and the first thing it's going to test is the previous resistance at 480, for example. So from 420 to 480, there's a potential here to make 60 cents, right? So my risk here is about 20 cents. Okay, but if the trend do continue, I can potentially make 60 cents. So here I'm risking 20 cents to potentially make 60 cents. Now you get the idea? Okay. So now if the price, of course the price can still fluctuate. Remember your stop loss is at $4 or below 403, right? So if the price stays above 403, then it's fine, all right? Then you can see the price still continue to stay above the cloud. Okay, although it almost like going below the cloud, so you still don't do anything. But once it starts to move, then you are able to ride on the cloud. So remember, as long as it stays above the cloud, it can be in the cloud, but it has to stay above. It cannot go under, because under means what? A storm, right? So the price goes up again, and then here I'm not going to talk about where to take profits and all that, right? It again all depends on your strategy lah. All right, it all depends on your strategy, where you want to take profits and all that. Okay, but I'm giving you enough information already to actually use. Okay, now let's say you missed this out again. Okay, now the price is, you look at the cloud is now at 420, but the price is $5. So if you're going to buy at the current price at $5, you'll be at the highest risk because the price can pull back to the cloud, isn't it? So all you need to do is to wait for the cloud to pull back to its, so haven't pulled back yet, right? You can see the cloud is still thickening, right? It's still going up. Yeah, that means if the price pulls back, there is still potential for the price to continue to go up strongly and break this high here as long as it stays above the cloud. So what I want to do is to wait for the price to pull back somewhere around these levels, okay, where the cloud is, because the bottom of the cloud is here, right? At this moment, 490. That's the bottom of the cloud. I do not want the moment the price goes below 490, that means it's already in a bearish trend. So I want to buy somewhere here. Maybe if I buy around 5 to 520, okay, even if I buy at 520, I put a stop loss at 590, it's only 30 cents stop loss or 30 cents risk for a $5 share. Not so bad. But there's a potential if the price rebounds and go higher than 580, I can have a better potential profits. Okay. So the idea is to find for stocks that are above the cloud if you are on a bullish bias, right? And buy and start look for opportunities when the price pulls back near the cloud. That's when your risk is the lowest. So that's where we catch the bulls by its horns. Okay, not when the price is already at its historical high or at the highest level. Wait for it to pull back, and in this indication, wait for it to pull back to the Ichimoku cloud indicator. Oops, I suddenly got cut off. Hold on. Okay. All right. So the idea is basically to, again, like here, current price of SIA, the cloud is down here, right? I want the price to come down and pull back towards the cloud, possibly around 5 to 520, right? Because if I'm going to buy somewhere over here, and if I put a stop loss below the cloud at 490, it gives me between 20 to 30 cents risk per share. Okay, but if the price does rebound, and if the price stays above the cloud, there's a very high chance it's going to rebound outwards and go higher than the previous high of 580. Because why? Because the cloud is expanding upwards, isn't it? Moving towards the future. Okay, so this is a good chance to buy around 5 to 520. And if the price goes up, you just can ride the trend. Okay. So you can apply the same thing across all the other counters, as long as the price, first of all, is above the cloud. So you can just apply a chart and see, number one, if it's below the cloud, then just look for a next chart, right? Just look for a chart that's above the cloud. And your buying opportunity comes where you want to catch the bulls by its horns, is when the price pulls back to the cloud. Okay, so I think that's all the time I have. I can only show you one example, all right? But what you can do is, I'm just going to make some announcements before we end this. Okay, if you want to, if you want to learn further on how to use the cloud indicator and some other tools, you know what? You are able to join us actually on our Trader Circle program, which I personally be conducting. You'll be held on the 5th to 6th of June. Okay, this is one of the indicators that we'll be using as well. And of course, apart from other indicators, right? So if you're interested to attend this program, it's going to be live online. So you can be anywhere you want, right? Just log on with your computer and your screen, then you are set to go. A 2 days program. If you are interested, just put in TCP or type in TCP on the comment section. Then our colleagues will get in touch with you. Right, just type in TCP. This is where we're going to focus more details on your entries and also where to set target prices and all that. So at the end of the Trader Circle program, it's not about learning charts. I mean, of course, it's about learning charts like what I teach you today, but it's more about how you apply it, okay, and come up with a trading plan to trade those stocks. All right. So type TCP if you're interested, and the next session is going to be on the 5th to 6th of June. Okay. Now, if you are interested to open an account to trade Singapore shares, all right, you can go to any of these brokers over here. Okay, we have 2 online brokers, which are Poems and Tiger Brokers, and you can also approach any of these investment banks which are currently here in Malaysia, and stockbroking firms here in Malaysia, which allows you to trade the Singapore market as well. If you want to get more information on Singapore stock market, just go to their SGX website. You can even download the SGX mobile app to get this information. Okay, there are quite a number of information you can find there, right? Resources, articles, news. You can research reports, and you also have some tools for you to use to identify opportunities in the Singapore market. All right, so just go to SGX website. To continue learning, we have also created a group called ET Online Campus SGX. All right, so just go to ET Online Campus SGX or search it on your Facebook. It's actually a Facebook group. You just request, and that's where we have all discussions regarding Singapore stocks. All right. Okay, maybe I'll answer 1 or 2 more questions. If you guys have, then I can end it here. If there's no questions, we'll just end the session here tonight. All right. So like I say, if you're interested in the TCP program, just type in TCP. Our colleagues will get in touch with you to provide you with more information. All right. So the next class is going to be on the 5th to 6th of June. Okay, so if there's no questions, then thank you very much, everyone, for joining me tonight. We're going to have a session tomorrow as well, so just join us. All the details are on our Facebook page. So we'll see you again. Thank you very much and have a good evening.